And we have just 1 second left for the market to open, and let me just hop across to the wall here to tell you about how the market opening is shaping up. Remember, the pre-opening rates have been pretty strong for the market, so looks like the first tick on the index is also going to be a decent one. It's a flat opening for now, a tad bit in the green, as you can see over there. The Nifty holding on to the 21,860 mark. The Sensex as well, absolutely flat, not doing much at all. But let's take a look at some of the big gainers. Tata Motors is the big one to watch out for. In pre-opening, remember, there was a 7% rally that we saw in Tata Motors. There you have it, 4.5% higher on the back of a strong set of numbers coming through. Next up, on the downside, actually two stocks that I'm watching out for on the index. One is, of course, SBI, where the earnings were hit by one-time provision. So let's see how SBI has opened up this morning. It's a 1% cut just below that 650 mark on SBI. And after that, you have UPL, where, Sonal was just telling us about how the numbers are on the weaker side. So UPL is something that could be under pressure this morning, down almost 4.5%, so the big Nifty loser in trade, UPL there. Apart from that, Maruti was also dragging its feet in pre-opening. Remember, the management just told us a while back that there will be low single-digit growth for the passenger vehicle industry in FY25. So Maruti is really, not under pressure, but you'd have to say opened in the red, still hanging on to 10,600 for Maruti. And Aurobindo Pharma is the other one that I'm looking at. You just saw Ekta tell you about how the US FDA unit has been inspected. So Aurobindo Pharma, look at it there, 4% lower. There's also some volume, hit that we're seeing on the downside over there. Indigo is the other stock that I want to look at this morning. Remember, there's been a 5th consecutive quarter of an up move in Indigo's profits. They have reported profitability for 5 quarters now, 4.5% higher. And talking about the profitability, first quarter of profits for delivery. So that's another stock that we'll be looking at. Big moves coming into many of these, new age tech companies there. But okay, delivery down almost about 1.5%. But all in all, you'd have to say very, very flat opening. Of course, Nigel will take us through a couple of other numbers. There's Bank of India, there is Med Plus Health, all of them reacting to their earnings. But otherwise, the first tick on the index is absolutely flat right now. I think the drag is coming here on the Nifty Bank, which is down almost about 250 points now. That's courtesy SBI and a couple of other banks like ICICI Bank. Look at Bank of India. I think the director just showed me that stock. Big knock on Bank of India this morning, down almost about 7.5%. Back to you guys.
Well, that's right. In terms of the Nifty, the big loser really is UPL. The numbers look disappointing, and as we mentioned, that it could possibly be exiting the Nifty, going by the calculations. So that's one stock that's under big pressure. Stocks, besides that, stocks that are doing well today. NHPC, beautiful move out there. The stock is up close to around 10%. SJVN, big up move is what we're seeing on that stock. Just take a look at it. Massive volumes on that one. Nava Limited, well, it came out with its set of numbers late in trade on Friday. And that stock was trading high with a gain of 2.5% odd. It seems now the street is digesting those numbers. They're debt-free as well. So that explains why the big move that what we're seeing out there. IREDA, well, that stock is well up close to around 4.5%. It's a 200 rupees stock, IREDA. Just take a look at that. Did an OFS at, the listing at around 30-35 rupees odd. That stock is up and about in trade. SAIL continues its good form, so that's up close to around 3% as we speak. Paytm, the door is shut. Again, sellers at lower circuit, down close to around 10% approximately. What else is moving in trade? Well, you have NBCC that had opened up well in the green, but that's flattened out now. It's trading with a gain of just 1% or thereabouts. Metropolis had opened up in the red. That's moved into the green. Now that's up close to around 1%. And you have a couple of other notable movers in trade. Auto Pharma down close to 3.5%. And IOC, the OMCs continue to re-rate up close to around 3%.
Nigel, it's a absolutely flat Nifty screen at about 2185. But look at what's going on in the rest of the market, right? Incredible. NHPC is up 12%, and Indigo is up almost 3,300 on Indigo. 3264 actually, to be precise. IREDA is up about 5%, 205. NLC, that's Neyveli Lignite, is up 5.5%. So, you got those elements of what did the best over the last many sessions, which is the PSU pack once again showing very clearly. Another one is Rate-Gain. Rate-Gain reported numbers, I think, during market hours on Friday. Stock went up sharply, some 6-7% within a matter of 10 minutes, and then it's up another 3% this morning. Numbers are very good. Satin Credit Care is up about 6%. VATech Vabag is up about 5%. KPI Green comes up with a 5% pop. And I think we mentioned Castrol, which is starting about 3.5 higher at this stage as well. On the downside, of course, I mean, there is Paytm, which is selling off a little bit. It's down, not a little bit, 10% again this morning. It's it's a low circuit now, 10% down. Bank of India, I don't know if you guys mentioned, 8% lower Bank of India, 139 on that one. And of course, UPL is down another 4%. It's a story of sort of constant disappointments there. And a turn will come, but it's kind of out of sight right now, and turn in business. EIL is down about 5%, so 247. Bandhan Bank starts about 2%, 2.5% lower. South Indian Bank, which has rallied quite a bit in very sharp ways, down about 2.5%. And Tube Investments is down about 8% as well. So keep an eye out on that one as we move forward. So more on this in terms of specific stocks, etc. But it's a very vibrant open. I mean, there are more gainers than losers. 1,300 stocks are higher, 780 stocks are down, but it's vibrant and a lot of volume, a lot of activity, the kind of market open that you would like to see. Lawrence Belanco of CLSA is now joining in, somebody who tracks price action very closely and is also followed very closely by both who track technicals but also those who track fundamentals. Lawrence, great to have you with us here, and always great to get your views on CNBC TV18. We on Friday hit a new high, all-time high, just about a 2-3 point higher high compared to the previous one, and then there was a significant cool-off. Are we at a bit of a crossroads? Do you think there is enough in the tank for the market to continue marching higher? What's your view?
Yeah, look, in the short term, Friday's intraday reversal, and what I mean by intraday reversal, as you said, you made a marginal new high, but you were unable to hold on to those gains, and we closed towards the lows of the session. Something else to consider is if you look at the rate of change indicators from an RSI to a stochastics, you've also seen lower highs there. So all those sort of points that we have seen some slowing upside momentum, and what we should expect is at least some kind of pause and consolidation in the Nifty. The support area that we see coming through is around the 21,000 to 21,300 area. So that's the bottom end of the range. And I think that would sort of be the best case scenario, that we're just going to a holding pattern down towards that support area and just have a time-based correction before the breakout. And remember, the breakout from the 2021 to 2023 trading range still has an unmet upside target of 23,000. So short term, yes, I think a bit more volatility and a correction is due. But longer term, there's still another upside target of 23,000.
Hi, Lawrence. Good morning. Lawrence, the near term, if we could be in for a bit of a correction, how deep can we go? The Nifty is currently at around 21,800. So how low can we go?
So basically 21,000 to 21,300 is where support is. So 21,300, the significance of that is the 50-day. And then the lows that you made in December, as well as the lows in early January, sit around that 21,000 area. So that's what we would sort of define as the bottom end of the trading range that the market can hold in. And that would be a shallow time-based correction. Clearly, if you break below 21,000, that's when we run into a deeper scenario where the next support area comes through at around the 19,800 to 20,000 area. So that's roughly where the 200-day is, as well as the August-September high from last year's. But at this stage, looking at how the market's trended, it's taken the time-based correction, meaning you go sideways in a trading range. So that would be our base case on what we're seeing currently, and more rotation beneath the surface. And that's why the market takes a pause rather than a more significant decline, because you're getting rotation beneath the surface.
Okay, that's interesting. So you're looking at short-term volatility, and you're seeing in the shorter term, perhaps a corrective phase is upon us, but in the medium term, there is a big up move. What about the Bank Nifty? If there is a corrective phase, do you think that would be led by the Bank Nifty, and what are the levels to watch there?
Well, it's interesting. It has been led by the banks, and talking about rotation within the market. If we just look at the Nifty and take the two largest cap stocks within the market, HDFC Bank and Reliance. HDFC Bank's post results has turned sharply down from the top end of its 3-year trading range, which is around that 17,030 area, and the downside of that trading range is back at the 1,300 area. So we think there's still downside risk there. But then on the other hand, you've got Reliance breaking out of a 2-year trading range that you've still got upside targets of 3,400. So you can see those two market moves of the large cap stocks squaring off and keeping the Nifty in the current trading range. But to go back to your question on the Nifty banks itself, you do have support around the 44,000 area. That's roughly the 200-day and the most recent lows. And if you did break below that, we're talking about a move down to 42,500. but it's really the private sector banks that have been weakest, dragging that broader Nifty Banks index lower.
What's the level on HDFC Bank you said? You said that there is some more downside left, right? Is it 1200 that could be a base, or could it get worse on HDFC Bank?
Yeah, so there's strong support that comes through at the 1260 to 1300 area. That's the bottom end of the 3-year trading range, but we do expect to see a test of that level.
Lawrence, we'll ask you for your positional ideas in terms of specific stocks, etc., what you like and what you'd like to, on both sides in a bit. But how are global markets doing? Your view on the US 2-year, 10-year, whatever you track, and equities, the S&P and the NASDAQ.
Yeah, so let's start off with the 10-year yield. And what we saw post the reaction from the non-farm payroll numbers in the US Friday is you've clearly got this new support area on the 10-year yield, which sits at 3.75 to 3.78%. And the upper boundary of this new trading range for the 10-year yield comes through at the 4.16 to 4.3. So we are seeing the 10-year yield settle in a new range and a slightly higher range than what we saw through last year. And what that's mean from a global standpoint is it's been quite a selective market advance at the start of this year. So, if you look at global markets that have performed, Japan been up there with the AI NASDAQ related stocks. And obviously India has also participated in that move. But you've seen US small cap stocks, which outperformed in the fourth quarter, being negative for the year. So again, like you've seen rotation within the local market, you've seen rotation within global markets, which have also centered back to growth AR related stocks in the US. And on global basis, you've seen Japan, India, and Mexico, again, be the outperformer. So a very select handful of markets with yields holding in a higher range. I think for a broader rally in global markets, you need to see yields declining again, and that means a break below 3.75% is what you're looking for on the 10-year yield.
All right, that's going to be the trigger for global markets, and 3.75% on the 10-year yield. Lawrence, you said, we could be in for a bit of a correction, and then we go back up to around the 23,000 odd mark. And Reliance Industries, as you pointed out, has been one of the top performers. What are the levels you're looking at in terms of Reliance Industries? Where does it go?
Yeah, so the breakout of the 2-and-a-bit-year trading range that you've seen recently with the move through the 2,800 area gets us an upside target of 34 to 3,500. So we still see further gains for Reliance, strong momentum. And like I say, that contrasts to the price action you've seen in the private banks, particularly HDFC. So, those two are sort of cancelling each other out at the index level, leaving it range bound, but Reliance still has that 34 to 3,500 rupee upside target.
Do you have any thoughts on Tata Motors? It's been the big breakout story in the last 1 year. It's doubled and now almost 1,000 rupees. Are you tracking the charts and do you see further upsides here?
Yeah, I don't have any fresh upside targets on that name, but obviously has strong momentum, which reinforces the uptrend. So would continue to give benefit of doubt to that uptrend that is extending within that space. Again, within autos, it's a far more select handful of stocks sort of driving to the upside. We've seen a few more rollover like Maruti Suzuki and Bajaj Auto, which is showing some slowing upside momentum. So again, more selective, but Tata Motors is showing strong upside momentum.
Okay, that's on Tata Motors. Anything else that catches your eye, Lawrence, in the Indian markets? You spoke about HDFC Bank on the downside. You talked about Reliance. What about some of these IT names? Do you see them coming back into action in a big way on the technical front? And anything else from the index that you would like?
Yeah, IT is essentially in a holding pattern, and it is outperforming the banks, and that's because they're currently holding trading range levels post their results. But it's not as if we're getting fresh momentum signals like we've seen the breakout in Reliance. But if I can sort of share, gain through the rest of 2024, I think one of the key drivers from an emerging market side is emerging market small cap stocks. And if you look at emerging market small cap stocks versus developed market small cap stocks, November last year, we actually broke out of a 3-year basing pattern. And that basing pattern followed 10 years of underperformance by emerging market small cap stocks. And within the emerging market basket, Indian small cap makes up the biggest weighting. If you look at the iShares India small cap ETF listed in the US, you've broken out of a 3-year trading range, and that gives us an $84 to $85 upside target. So, in this volatility that we've seen in the short term, I think investors can look at adding exposure to Indian small cap stocks via that ETF, or obviously at the individual stock level. But I think that's a space that can continue to work within India, and you can use weakness in this volatility that we've seen currently as a place to pick your spots to add exposure.
All right, we leave it at that. Lawrence, thanks a lot for joining in. Appreciate your thoughts here on CNBC-TV18. Well, that's the word coming in on the technical side of the market. Lawrence Belanco stating that this market could see some volatility in the near term, but the longer term trend is intact. Don't lose sight of what's happening with a couple of stocks. Paytm is at a fresh record low. As expected, that stock once again is under pressure. UPL is down almost 5%, and on the upside, it's Tata Motors that's up about 6% post its numbers. Let's talk about Dr. Lal Pathlabs, though. The Q3 performance was quite disappointing. The revenues came in below street estimates. Non-COVID growth is also quite subdued. Dr. Om Manchanda, the MD of Dr. Lal Pathlabs, joins us now to discuss their Q3 performance. Dr. Manchanda, thanks a lot for being with us on the channel. I want to first start by asking you about the impact that competitive intensity has had on your industry, especially in some of the key markets like NCR. I ask because over the last 4-5 quarters, you've seen subdued growth, not just from your own company, but across the industry. Do you think things could get worse before they get better? And what is your own expectation on volume growth? I mean, this time it was 5% for the quarter. Is this something that you'll have to work with for the next few quarters as well?
Good morning. Thanks for having me here. I think within the industry, we are industry leaders, and our growth rates have been pretty good, double-digit for both on quarter as well as on YTD basis. The growth actually has come from across all the regions. And your question related to competitive intensity, I think over the last few quarters, we have seen sort of a subdued competition. And many of these people also have taken price increases. So I would actually say that our quarter, while it's been lower than expectation on volumes, but in terms of value, I think it's pretty in line with what we expected.
But do you think you will be able to do that double-digit growth that you had stated earlier? Is that your stated guidance even now by the end of FY24 and FY25 on the top line?
So both on quarter as well as on YTD, our value growth is double-digit. We are nearly about 10%. And this is coupled with both volume as well as revenue per patient. And revenue per patient definitely has impact of price increase, which we took last year. We hope to actually improve our performance and volumes going forward, but we're still very hopeful that we will be able to meet this double-digit number.
Right. Dr. Lal, generally the belief is, morning Prashant here, that you will outdo whatever industry grows at, right? Now, could you give us some ways, I'm talking about volume here, could you give us some sense on what that might be? How do you think about that number? What will the industry do and what will you do on top of it? And also on prices, where are we at, sir? Because I don't think you've taken any price increases in the past year. And when will we see any increases? When is it going to be possible? Go on.
Actually, volumes have two components. One is number of samples, number of tests that we do. That number has grown very significantly, nearly about 7-8%. It's the number of patient visits. It's not about unique patients, actually number of patient visits. Now that footfall can actually be impacted by disease incidence, season per se. We've also seen some impact of bundling on the footfall. I'll give you an example of, let's say, fever panel. Earlier, people would come for individual tests like dengue separately, malaria separately. Now we have one fever panel, so one visit does it all. So to that extent, volume definitely gets impacted. So I would say that we are looking at revenue per patient being impacted by multiple variables, not just footfall. And the number that you see on volume growth, actually, it's not about unique patients. These are all about patient visits to our lab. Now, since you know that our industry is need-based, it's not a want. So as and when the need is there, people would come. So overall, we have seen in the industry, the volume growth has been subdued compared to last couple of years. Now, there's been one hypothesis that is there any fatigue setting in because after COVID, people want to give it a pause. There's so much of testing that has happened. So let's see how it goes. But I think overall diagnostics will continue to remain the mainstay within the healthcare.
So the thing to watch is what? Sample? Is it, when we say volume, is it the thing to watch is what? Samples, number of patients, or revenue per patient?
I would say actually all revenue per patient, because that's a combination of many things. It's a footfall, it's also mix change because a lot of high-end tests being ordered now as the medicine goes into evidence-based. So you will see that higher order tests being prescribed also does impact revenue per patient. So there are multiple factors at play in terms of pushing the revenue per patient up. And we have seen the bundling, which is our SwasthFit, nearly about 30 tests in one go and actually pushes up the revenue as well. So there are multiple variables at play to look at it. So volume alone is not the variable.
Okay, all right. Good morning, Dr. Manchanda, and always good to see you, Vin. Since you spoke about SwasthFit, let's take that forward. It currently contributes close to 20% of the mix. It ends the year closer to around 500 crores in terms of revenues. I wanted your thoughts on that. And what about next year? How do you see this scaling up? It's scaled up beautifully till now, but on an annual basis, what kind of revenue number will you be looking at from SwasthFit?
SwasthFit, I think last 2-3 quarters, we've seen it's stabilizing, as you rightly said, about 19-20%. I don't see this number now sharply moving up. We are seeing one very interesting trend now of bundling on higher end tests. So far, it's been more on routine tests where patients can on their own come and get checkup done. But I have seen even within the medical fraternity now, they're looking at bouquet of tests which can actually help them diagnose something early and in one go itself. So we are seeing some pattern of demand of bundling happening on higher order tests as well. In terms of growth going forward, I think it's a very well laid out strategy that we keep repeating often, which is about go deeper in northern eastern markets. That's where our brand is very strong. And you must have seen that we've been talking about tier 3, tier 4 towns. And I think the entire state of UP, Bihar or rest of North, we are just going deeper as much as possible. Go wider in South and West because those are the places where our brand is a long way to go. And we are looking at some of the larger towns. And that's where our whole inorganic and organic both strategies come in play.
All right. And tier 2 and tier 3, currently, how much do they contribute as a percentage of your revenues? I think it is around 30%. Yeah,
we've started giving this data for the last 2-3 quarters for our own sort of growth, for our own tracking as well. Nearly about 30% of our business is actually coming from that part of the pop strategy.
And it's growing at what clip in comparison to the NCR region?
I don't have that number exactly, but definitely it's higher than our portfolio growth because that's where the large population is for us to drive.
Okay, Manchanda, just that point on higher order tests, what do you mean? Sorry, I didn't quite understand. Are you saying that medical professionals are ordering them, or are you saying that expensive tests are being bundled together via these packages?
No, what happens, I know it's a little technical, in terms of, let's say, someone who comes from a cancer test. Now, normally, earlier a test will be prescribed for histopathology. Now, a test is also being done for histopathology as well as gene sequencing. So they are all clubbed together. So from the same sample, medical fraternity or doctors would want to have all the tests being done rather than samples being sent again and again. Though that's the early stage, but I do see that pattern happen.
Okay. So, overall, I just wanted to understand that you did mention that competition has eased a bit, but how is the online aggregator competition at the moment? Because, in the last 12 to 18 months, there was a big spike up that we saw in terms of online aggregators. Has that eased as well? And what do you think is the way forward now? What are the, consumption patterns looking like?
So let me correct myself. I don't think competition is eased, but I think I would say it's become level playing. They're all there. Earlier, I think there was a lot of deep discounting which was going on, and I think that is probably coming down. But competition is still there. This industry has always been very competitive. While some of these competition is visible that you and I see, but there is a very highly unorganized unorganized industry as you go down the pop strata. So competition is pretty much there because the entry barriers are not that high in this space.
So this revenue per patient, right, that you were talking about a while back, do you think it will be hard to scale that up given the kind of competition that is present?
I think so far, last 4-5 years, industry has not taken the price increase, but over the last sort of few quarters, we've seen some trend towards that. So to my mind, I think ability to take price increase on some of these tests may be easier now going forward. Second is, as I mentioned to you, the mix is also changing. It's just not routine tests which are being ordered now, high-end tests being ordered. That's also a favorable impact on revenue per patient. But I would say that as a company, we definitely keep an eye on expanding our footprint and keep our value proposition, the price value equation very, very strong. So to me, pricing definitely would be a last resort. Now, coming to your question of revenue per patient, I think we'll have to see as we go along. But
Okay,
a
all right,
combination of both volumes and RPP. Yeah.
Final question from my end, Dr. Manchanda. Give and take everything, the industry dynamics, the way you are running your business as well, changing the mix. What is the sustainable margin outlook for here on?
Absolutely. I think you see the number this year. We have expanded our margin profile,
Yes.
both operating margin as well as net margin. We run our business very efficiently, and we will continue to do that. We have actually brought in a lot of technology to run our processes very, very efficiently. We'll continue to do that. And we should operate within the range of 25-26%, although we are hovering slightly higher than that. But I would definitely reinvest some of that back into growth.
All right, we leave it at that. Thanks a lot for joining in. Appreciate your thoughts here on CNBC TV18. By the way, there's so much that's happening in the market. So let's take a look at a couple of these stocks. Interglobe Aviation actually is the one that you should be looking at. Big moves coming into those stocks now, aviation stocks. It's not just aviation, it's the entire travel space which is doing very well. Interglobe is up about 5% of course, post its numbers. But take a look at some of the other names, right? I think Lemon Tree is also at a fresh high. I just saw that quote on that one. Look pretty strong, 2.5% higher, fresh high on Lemon Tree, up 22% right now. And Interglobe Aviation is also at a fresh high, up about 4.5%. The thing about Interglobe is that the numbers are very strong on all fronts. It's the 5th consecutive quarter of reporting profits for Interglobe Aviation. And as I said, it has 80% market share in some of the monopolistic routes. So Interglobe Aviation, is the biggest beneficiary of this travel boom that we're seeing. Revenue growth of 30%, EBITDA up 61%, margins have improved substantially, and profits have doubled on a year-on-year basis. So this stock is, one name that the street definitely likes today.
Okay, all right. Well, let's focus on LIC Housing Finance then. Q3 was rather weak showing, with disbursements declining on a year-on-year basis, and AUM growth as well has slowed down. Mr. Adhikari, the MD and CEO of LIC Housing Finance, joins us on the show. Hi, sir. Good morning. Thanks so much for joining in. Well, give us a brief idea in terms of disbursements on a quarterly basis. What should it look like, in the coming quarter and from year on? And also, could you guide us in terms of AUM growth? What do you end this year with? That's FY24 as well as FY25?
Looking forward, I think I'm very positive. The company will continue to do well. We have been doing well as far as the profits are concerned, much above what we have done in the last entire financial year to put together. As far as the AUM book is concerned, yes, the growth has been tad slow. But I think we need to realize that this has been a year of consolidation for LIC Housing Finance. At the beginning of the year, we went in for a major technology upgrade. We also went in for large-scale restructuring of the organization. So put together, it has been a year of consolidation. Quarter on quarter, we have seen growth in our business. Yes, the AUM growth stands at 6%. Q4 is going to be better, much better than Q3. But the consolidation will go on forward. Looking forward to FY25, I think we will start delivering in FY25.
All right, Mr.
Steps
Adhikari,
we've taken, the technology upgrade, the restructuring, that will bear fruit in the quarters of FY25, and I see a guidance of at least a growth of 15%.
15% AUM growth, right? 15% AUM growth, Mr. Adhikari, for FY25?
Yeah, FY25.
Got that. And could you tell us, what is the current ticket size? What's going to drive this growth going ahead in terms of disbursements as well? Will it be volumes, or do you see the ticket size as well going up?
Well, our current ticket size is around about 25 to 27 lakhs. That is the ticket size. Yes, I do agree, slightly on the lower side as compared to my peers. Yes, we are definitely looking at increasing the ticket size, moving on to bigger markets. A major thrust this year has been on growing our distribution channel. We have been seeing some traction in that. Distribution channel has grown, so that should bear fruit. Yes, it's not going to be very huge. We're not going to jump from 25 lakhs to 50 lakhs or something like that. But definitely, there will be an improvement in the ticket size. And there will also be a growth on the loan book also. As I said, guidance of about 15% growth in the loan book in FY25 is what I'm looking at right now.
Mr. Adhikari, good morning. Prashant here. Could you talk to us a little bit about, what are the kind of spreads that we should kind of model in that you will make? They're at about 2% right now. They're high. They're higher than what you have done in the past. Is it sustainable? should we expect this to go down going forward?
Going forward, I believe it will be slightly moderate. It will moderating, I think, and maintaining the spreads. We'll be doing well as far as spreads are concerned, 2% right now. But I don't expect a major change or a moderation in the spreads. Should of course, the aim and attempt will be to try and moderate it. But this is largely driven by retail. The spreads are largely driven by retail loans, which we've been selling. In the coming years, 85% of my book is on the retail side. Looking forward to diversifying this in the coming fiscal. So I think spreads, yes, should be more or less there. Don't expect a big downslide in the spreads.
So back down to what? I mean, 1.5% from current 2%. Is that something like that, in that vicinity?
Yeah, somewhere on that.
What is the current cost of funds, sir? And how do you see that moving from here on?
From here on?
Yes. So what is the current cost of funds? Say in the last quarter and the previous quarter, what was the cost of funds and how has it moved? Because that in turn will impact your NIMs, right?
Well, the cumulative borrowing cost is around about 7.70 at the end of the quarter. Yes, there will be pressure on the cost of funds, I believe, but I don't expect a big downslide in the previous quarter. There hasn't been too much of a sort of increase in the cost of funds. The NIMs were okay, restricted only. We went down by just 4 basis points. So I expect the cost of funds to hold at the current levels of 7.70%.
And that means NIMs will be stable around this 3% mark.
Yeah, the NIMs, 3%. We've done well, I believe, in NIMs as far as the NIMs are concerned. Just down by 4 basis points in the current quarter. Yes, there would be a pressure on NIMs, but I don't expect too much of a sort of worsening of the NIMs. At the most, 10 to 15 basis points at the most. Guidance of 2.8 plus is what I'm sure we'll be able to deliver.
Got it. Final question before we let you go then. Give us a sense in terms of how does asset quality and credit cost guidance as well from here on?
The asset quality has been improving. Yes, this was a major, I think, worry for all of us when we started the year. The quality was not good, especially on the project or the builder loan book. Yes, we have been working hard. We have taken steps, wherever possible. There have been negotiations going on. A lot of positives on the negotiations front. Then again, wherever possible, we have taken legal action, whatever is available to us, whatever legal recourse is available to us. So yeah, asset quality has improved, and going forward, I see a continuous improvement in the asset quality.
All right, Ms. Adhikari, we'll leave it at that. So 15% AUM growth for FY25, spreads around 1.5, NIMs around 2.8. That's broadly the picture coming through from you. Good luck, sir. Thank you for joining us here on CNBC.
Thank you so much.
Okay, well, the market's booming. Look at the Nifty. 70 points now, 21,920 is where we're at. We're at the day's highest point. So slow start, but never rule it out. Never rule, the market to do its own thing, right? The day's high, which is a new all-time high on Friday from where it cooled off, was 22,126. We're at 21,925. So, I mean, that was a big move on Friday, but this is looking strong in any case. So
I just want to mention the stock of the moment is UCO Bank. Just pull up that chart. It's 17% higher now on UCO Bank. And I mean, ever since UCO Bank came out with its numbers, actually, the loan growth was very strong for that particular bank. The NIMs were stable, etc. But today, I think the numbers came last week, but today the stock is really piling on the gains. Just look at that, 17% higher.
Just one point on UCO Bank, Sonia. There's only 3% in the open market because the government of India has more than 95% and LIC has 1.5%. So the float is very limited. But as you said, the numbers look quite good.
Oh, absolutely. Even IOB, 13% higher there. So
PSU
it's
banks,
it's the day belongs to PSU banks. Let's do one thing. Let us take a quick break. On the other side, Arun Maheshwari, Joint MD and CEO of JSW Infrastructure, will join in to discuss their Q3 earnings. Stay tuned.
Welcome back. Well, we have some news that's coming in there on Shree Cement, and that explains why the stock has moved to the low point of the day. Sources tell us here at CNBC-TV18 that the Income Tax Department has issued the final notice to Shree Cement post the completion of the probe. And the IT department has issued a notice to Shree Cement in January for approximately 8,500 crores of tax evasion. And they had conducted, remember, this search in the middle of 2023, that is June 2023. And from then, the stock has been a little bit nervous. And now it explains why the stock has moved to the low point of the day. The tax liability, however, that's the important number that comes up for you on the screen. The tax liability could be to the tune of close to around 4,000 crore rupees odd. So this has been an ongoing thing. And now we have a few numbers that are flashing for you on the screen. Tim C will join in and give us further details. I'm reaching out to Mr. Bangur as well and team and trying to get a response on that front.
All right, so more on this in a bit. Look at the market, 90 points now on the Nifty. I mean, we took that break, we were up 70, make that a full 90 points and approaching the 3-digit gain mark now on the index at the day's highest point. I mean, we've been trading for less than an hour, to be fair, but it's picked up quite a bit. JSW Infrastructure reported a good set of earnings for the third quarter. Their revenue saw a healthy jump, while margins also expanded. Arun Maheshwari is Joint Managing Director and CEO of JSW Infrastructure, is joining in right now to talk about the earnings and how the picture looks ahead. Mr. Maheshwari, great to have you with us here. Good morning. Thanks for your time. Could you talk to us about the big drivers behind the volume growth and the top-line growth that we've seen in the third quarter? The newly acquired assets have started contributing to the overall revenues. To what degree? Can you provide us with some numbers?
Acquisitions, what you have seen, has not really contributed in this particular quarter, which has recently gone by, because those assets were just about 10 days or 7 days old. So that addition to the volumes are very insignificant. The large part of the volume growth and the revenue growth has come in from the utilization at our Paradip assets, which is iron ore and coal assets, and some decent volumes pick up in all other ports. There has been a significant increase in the utilization of the coal terminal, which is just about the third year of operation now, and iron ore, which is the fourth year of operation. So these are the new terminals which were added about a couple of years back in our portfolio. And a very modern terminal, the utilization has started growing right from day one. And this quarter, we have seen significant jump in those volumes as well. So that has really largely contributed to the volume growth for the quarter.
So what was the proportion of the third-party volumes in Q3 and what was the inter-group volumes, if you can just help us with that?
So the third-party growth of cargo is a combination of liquid containers as well as bulk. If I had to look at the bulk side of it, iron ore and coal, as I said just now, is all third-party largely coming in from Paradip. Container terminal, which is relatively new in our portfolio, is just about 1.5 years of operation. It has been going steadily going upside. So it has added to one more volume. Liquid, as such, we didn't have anything in our portfolio. So I don't see any growth getting contributed from liquid side in this quarter. However, the coming quarter, you will see liquid coming in because our acquisition of Fujairah Oil Terminal, which is just about 10 days old as of 31st December, the full quarter impact will come in this quarter. So you will find a liquid contributing our growth journey from this quarter onwards.
All right, so, new assets have been acquired in quarter 3. So what will the growth be in quarter 4 on a year-on-year basis? And how much will they contribute to your growth? Give us a sense of FY24 guidance.
New assets which we have acquired, they have been running successfully almost on 90% plus capacities. However, if I have to look at PNP as a port which we have acquired, which is a 5 million ton capacity port, it has a approval of up to 19 million ton, 19. So once we have stepped in, now we would like to mechanize, modernize, and we would like to scale up that port. So the potential for that port is up to 19 million ton as we talk today. So we will have to make a layout of the capex plan and the more marketing of that port. By virtue of this port will grow further from here on. Coming to the oil tankers terminal, that is running at 90% plus capacity utilization. However, there is an additional piece of lease land which we can acquire over there, and we can build additional capacity over in that terminal, which we are assessing now. How do we do that? So these are the two upsides available on these two acquisitions, what we have done, other than what the synergy we can bring in from our existing assets in those terminals. Coming to the quarter 4, typically in our industry, quarter 4 is strong as compared to last 3 quarters because the quarter 1 and quarter 2 are generally monsoon in India. And quarter 3 is slightly better. And quarter 4 remains the robust one because of the large contracts take or pay and everything gets built into the quarter 4. So the volume, what we have seen in the past has been generally better in quarter 4. And we don't see any significant change from that trend in this year also. So I think quarter 4 should remain good.
Mr. Maheshwari, let's talk about the Kenny and the Jatadhar ports, which you recently secured. What sort of development capex will we see there? Will you have to do? And by when will these sort of become, the expansion of the ports be complete and they start contributing?
Any port, we just signed the concession agreement in the month of November last year. And we have already started working towards the environment clearances and other related clearances for that port. Hopefully, all the clearances should be coming in another 6 months or 1 year time kind of stuff. And thereafter, the project construction will commence. Typically, it takes about 3.5 years to construct a port. So from today, if I have to look at it, about 3 to 4 years kind of time frame, I can say, for Kenny Port. And the total capex outlay as projected is about close to 4,100 crore rupees for that. So thereafter, the volume will start picking up over there. Coming to Jatadhar Port in Odisha, this is the concession, all the approvals are in place in that case. The concession agreement is likely to be signed within the next 4 to 6 weeks by JSW Utkal, which is a subsidiary of JSW Steel. Once that is done, then we'll apply for novation. And thereafter, we'll start constructing the port. So given the time frame and what we expect, it should be again another 3 to 4 years time, we should be running that port as well. And in that port, we expect to spend close to about 3,000 crore rupees. So total, both port put together, close to about 7,000.
All right, sir, we have to ask you this final question before we let you go. Our team had reported your intention to acquire Navkar Corp recently. Could you clarify your interest in the company and also your inorganic growth strategy from here on?
See, the thing is that, being a big player in this industry now, and with an appetite to grow with a strong balance sheet with us, we keep exploring multiple opportunities and many opportunities keep coming to us. Not necessarily that it is one or the other opportunity. So I would not like to comment on any specific opportunity as of now, but we do have an intention to get into that last mile connectivity space and all. That's why we have purchased a CTO license and we have been exploring several other opportunities wherein we can differentiate from the existing only port operator to a service provider till the last mile connectivity. So I would like to rest my comment over there rather than getting into any specific opportunity which we are exploring or not. As the time passes, probably we can discuss more about several other opportunities which we are looking at today.
Okay, we'll let you go on that note. Thanks a lot for joining in. That's JSW Infra. Let's look at the market still holding steady actually. Bikaji Foods is the other stock that we're looking at this morning. Q3 was a good quarter for them year on year. The growth was led by the packaged sweets business due to a shift in the festive season. The company's COO Manoj Verma and the CFO Rishabh Jain join us now to discuss their Q3 performance. Gentlemen, morning to both of you and thank you for being with us on the channel. Manoj, I want to start with you because, overall, you had targeted for the full year, FY24, your volume growth would be at 18%. And in 9 months, your overall volume growth is already almost 17%. So would you want to scale up your full year volume guidance? If yes, how much do you think you can do? And what's your early estimate of what FY25 volume growth could look like?
Good morning, everyone, and thanks for the opportunity again. Yes, indeed, this quarter has gone very well for us. Now, if you look at in terms of volume growth, has been ever highest volume growth, which is a number of 29.5%. Well, in terms of outlook for the year, if I was to say for what we said, we will stay now around it. Q3 is very, very high for us because of, as we said, that there's a shift of Diwali and gifting sweets did extremely well for us. So which has brought in huge contribution to it. But yes, the year will end around the numbers what we spoke about. Talking about next year's number, now if we were to look at, so we would look at say around 18 plus minus % volume growth next year as well.
Okay, so you're saying FY24 also you'll stick to 18% and FY25 as well you're looking at 18% growth. Got it. Just one
18
follow-up
plus
there.
minus, yeah. Yeah.
18 plus or minus, okay.
Yeah.
Which is the segment where you're seeing the, I mean, this quarter, of course, packaged sweets has done very well because of the shift that we've seen in festive season. But between ethnic snacks, packaged sweets, Western snacks, which is the segment that is growing the fastest and where, you know, expectation is that growth will pick up?
See, gifting and sweets is basically, you know, more dependent on the Diwali and festive around, right? Howsoever, we don't miss opportunity on these categories. But no, the core to us is our ethnic snacks. And that's where if you look at, no, even in this quarter, the volume growth has been 19%, which is extremely, extremely good. And a value growth of 15.4%.
All right. Hi, good morning, gentlemen, and good to see you all in. What about margin guidance from here on? Is the best of, you know, the lower raw material cost already in the price, or do you all think there's more to come?
Thank you very much for taking us. So basically, from bottom line perspective, we are on track for this year margin profile, and that's what we targeted early year and budgeted that we will be at close 13% type of EBITDA. And this quarter normally you will see in second third quarter our ad cost spend go very high. Normally 70% of overall year spend goes in these 2 quarters. So normally and also there are few raw material which the price has been increased like chana dal and everything which has impacted us close to 0.6-0.7% in gross margin. But overall we are on track and we will be on a margin profile. That's what we're targeting.
So margins will be approximately this 13 to 15%. Could you give us a number? EBITDA margins, Rishabh?
Yeah, so from EBITDA perspective, at a full year level, we'll be upward of 13%.
Upward of?
13%.
13%. Got that. Also, you know, you had commissioned this new facility, frozen facility in December. That was as per plan. It has a huge scope in terms of revenue out there, revenue potential. Could you tell us utilization levels? How does it move from here on?
So basically, in next 2 quarters, so of course, it's as per plan, we have installed the capacity, and in next 2 quarters, we'll do a lot of new product innovation in that plant because frozen and new capacity which we have built in. But yeah, this can bring a good revenue in next 2.5, 3 years. So it can be a potential of plus 200 crore of revenue in next 3 years.
Okay, gentlemen, hi, morning. Prashant here. You know, actually, one big lever for you is, I mean, you know, your distribution, right? How many outlets do you have and direct outlets and where all you are present? I mean, that'll do the trick. The product, I don't think needs much pushing in that sense. So just give us a sense, Rishabh, in terms of just the overall touch points, direct distribution, what's the aim?
Yeah, so basically, from direct distribution perspective, currently we are at close to 2.5 lakh outlet type of thing. Our target is to be at close to 3.5 lakh outlet in next 2 years. And our total reach is around 10 lakh outlets what we have as of now, but our target is to be at around 12.5 lakh outlet in next 2 years. It's important thing, and that's what we are focusing on. We have built a team in last 1.5 years, added more than 300 plus sales team in our overall strength, total sales team strength. So that's where we are focusing on. Largely, our 70% revenue comes from 3 states, Assam and Bihar. And that's where there's a lot of scope in core state as well as a lot of scope in our focus state. That's where we are focusing on.
So when we say direct distribution, Rishabh, that means outlets, own outlets?
No, not own outlet, but yeah, that's where our own sales team goes and visit the outlet. That's long connectivity in our own DMS.
Okay. Just 2 quick questions before we run out of time. One, if you can tell me what is your current market share, Rishabh, in the core markets that you are in, and has it gone up since the last time we spoke?
Yeah. So overall, from core market, our average business share is close to 43-44%. Where in Assam we have plus 55%, in Rajasthan we have 47-48%. So, but yeah, of course we have grown in our business share compared to last 1 year.
Okay, so 43-44% core market share is what you said, right? And can you tell me what is the scalability that you're seeing in the recent acquisition you made of Bhujia Lalji? What is the expectation of growth there?
So Gujaralji, so it's a small company and it's a big scope to grow. Our target is to be this company can become 100 crore top line company in next 3.5 years. That's what we're targeting on.
Okay, gentlemen, thanks a lot for that. Next time, maybe we can focus on the export market. Why should we just enjoy crunching all the snacks out? Yeah, thanks so much and appreciate you joining in. For the time being, slip into a short break. You come back, we'll get you our focus on the commodity markets as well. Stay with us.
Welcome back. Well, let's get a quick handle on what's happening in the world of commodities. Manisha Gupta is joining in. Manisha, what's the one commodity you're tracking today?
Well, Sonia, I'm looking at the global food price index and good news from there because the food inflation globally seems to be coming off. So when you look at the January FAO food price index, it has declined to the lowest level in 3 years and we have seen a decline coming in yet again. It has fallen by nearly a percentage point on a month-on-month basis and 10.4% on an year-on-year basis. So the food inflation globally for major price indexes seems to be easing off. There is strong competition among exporters is one thing that we've been looking at. Second is the Chinese demand is not so strong right now. Third is that there is arrival of recent harvested supplies coming in from the southern hemisphere for most of the producing countries. So there is enough food into the global markets right now. How does the global trade pan out? Well, that's something that the street will watch out for. And also, when you look at the global food index in numbers, that is in the negative territory since November 2022. So we've been seeing gradual flattish kind of moves since in last year or so in those markets there. So when you look at the vegetable oil, it has seen flat moves in the month-on-month basis, but on an year-on-year basis, it still is 12% on the weaker side. Dairy, same story here as well, flat on a month-on-month basis and a 17 to 18% of a decline on an year-on-year basis here as well. Meat also has seen a decline continuing into the markets there, 1.4% of a decline. It's a 7th straight month of a fall there as well. Sugar is something that has seen positive trends though. We have seen almost a percentage point of gain in the index on a month-on-month basis and 15 to 16% of a jump on a year-on-year basis still showing there. This is because there is support because of Brazil weather, and also the kind of curbs that we have in Thailand, in India is keeping the sugar prices quite supportive, and the markets are quite bullish onto that one going forward as well. Take a look at the cereal markets, and we have seen more than 2% of a decline globally there. The wheat and maize prices have seen a decline, but when it comes to the rice prices globally, that continues on a firmer note. In the Indian markets as well, we are looking at the rice prices trading at a multi-month highs there. The cereals, though, has a positive story because when you look at the world production, it's a record 1.2% of gain expected for 2023. The consumption also is expected to see a gain, but the global inventories are at a comfortable levels there. For the Indian markets, it has been about various steps taken to ensure that the inflation has been curtailed. We have seen export curbs come in for sugar, wheat, rice, onion, etc. And there is almost 0 to 5% import duty that we've seen in pulses and edible oil as well. I want to quickly take you through a last table, and this tells you on how the central pool is right now when it comes to wheat and rice holdings. So we had strongest of holdings actually in 2022, and then we've seen sharp decline that we saw in the previous year at 23. This is a multi-year lows when you look at the wheat stocks with the government and for the rice stocks as well. So for 24, the estimates are that we're going to be better than where we were in the previous year for a couple of those commodities. Wheat, of course, is a bit of a concerning situation even now, and we are sharply down as a yearly average that we've seen onto this one. But because we're looking at a better crop this time around, the expectations are that you could be looking at stabilizing prices for this one as well.
All right, let's do one thing. Let's take a short break on that note. On the other side, Lata will get chatting with Santanu Chakrabarti, the banking expert from BNP Paribas, to review their Q3 earnings performance of banks and NBFCs and their outlook here onwards. Stay tuned.
Okay, it's the end of results season, at least for the banking sector, with SBI's results announcement. The Q3 results season for banking and finance especially is considered formally over. And looking back, there appear to have been more misses than hits. Even the hits have been marked by more of mixed performances of either margins or slippages disappointing, even if loan growth and deposit growth were positive. NBFCs actually have done a tad better vis-a-vis expectations, but then even the mighty Bajaj Finance came in for some solid profit taking after the numbers because of the lower ROA, the return on assets. So how does one approach the sector here on, and what are the key takeaways from the results season itself? I have with me one of the best in business, Shantanu Chakrabarti, the banking expert from BNP Paribas. Shantanu, good morning. Thank you very much. First things first, SBI loan growth was very good, but everything else was, I think, under the weather. What's your take? Would you still go with that stock?
So, Lata, in SBI, look, along with loan growth, if I look at the margin performance also, quarter on quarter, a 7 basis point drop, where deposits have been repricing at the rate that they have, is not that big a deal. And frankly, nobody's margin estimates were too much higher than this. So even on margins, I would say it is in line. It is slightly weak other income and the exceptionals which has distorted. The exceptionals, even if you ignore, there's a small disappointment because other income was a little lower. But on credit costs, and this seems to be a theme for most, at least larger sized banks, the credit costs, at least for this quarter, has surprised in the positive. And people have been somewhat willing to take out, draw down upon reserves that they have built in previous COVID times. So SBI follows that theme as well. And I don't think the net interest margin movement of SBI will disappoint too many people.
Okay. Well, actually, this quarter as well, deposits have been hard to come by. Just saw a Shriram Finance advertisement for FDs paying over 9%. Therefore, okay, what will you say as takeaways? First for SBI and then for other banks. SBI would still be a buy, and you think margins won't be harmed much in the coming quarters?
See, the most interesting part to realize in the current situation is what has been harming margins for the banks. By harming, I mean what has led to the moderation. The key point which is leading to the moderation right now is a repricing of their entire FD book, and the fact that the FD book in proportion to total liabilities has been going up. Essentially, that's where it is. Now, if I do some back calculation, back of the hand calculation on the liability structures of most of the banks that have reported, you'll realize most of them would have reached blended FD costs of about 6.8, 6.9%. So with their marginals now running at 7.25, there's not too much incremental repricing.
Fair point.
From here on out, sure, when rates get cut, there's another small period of margin fade which can happen. But as you understand, in a falling rate environment, slightly down the line, there'll be more mitigating factors to that initial margin.
Absolutely. Yeah, we will watch out for what the Reserve Bank does to liquidity. If they seem committed to improving it, that perhaps means the worst is over. Okay, what else other than SBI did you like? ICICI price to perfection, would you say?
See, ICICI, we still see some upside to the multiple because unlike some of the other banks, for example, in the context of HDFC, when people are talking about current balance sheets, people take stock of what HDFC used to be earlier. But in the case of ICICI, we have to be fair to the bank. Given the balance sheet structure and the liability strength that are currently there, you cannot really compare it to a mid-2010s ICICI, where there were concerns around balance sheet and news flow around it was not so positive. So today, if I have to think of a sleep well bank where investors do not have to think too much about what quarterly volatility looks like, where the initiative has to be taken by other competitors to beat it, then that privileged position is enjoyed by ICICI. Is that reflected in the multiples? Because now it is a 16 to 17% core ROE bank, which is frankly trading at around the low valuations which HDFC is trading at, maybe at a slight premium. I'm not saying that their final valuations will be the same. I think HDFC will trade at a premium, as I've argued before. But that does not mean that ICICI looks unattractive. In fact, it is our second pick within the pecking order. I think the new ICICI needs to be recognized. And in a way, I think even HDFC's re-rating will help ICICI because it will re-rate the whole sector probably upwards. Once people realize,
HDFC, are you re-rating HDFC Bank now?
see, I mean, the trouble, I mean, since our last conversation, Lata, I had the opportunity to speak to investors as well. See, part of the reputation of a bank like HDFC Bank is that, you know, when guidances are met, there's a certain salience which comes with it, you know, and if the multiple of a bank is high, I'm not saying it's high now, but if the ask multiple were to be high, then there's a certain guidance responsibility that comes with it. And time and again, more market participants I spoke to, you know, it's not that people are shaken on the core thesis. It is just that they're a little shaken on the fact that, you know, probably the bank did not guide with enough of a margin of safety, given that it was undergoing a very large transformation. Now, the nature of such kind of a disappointment is that I've seen that go away very, very fast. You'd remember Axis Bank when, you know, Axis Bank with the new CEO coming in and had a guidance of 18% ROE, and then that did not get achieved. You know, initially there was a lot of similar kind of noise that I had heard from investors. How do I trust what the management is saying? Not trust in terms of credibility, but trust in terms of being able to rely on the sanctity of a guidance. And over time, if earnings continue to get delivered, if performance comes through, then you know, such a sentimental overhang does not outlast the weight of earnings. And I expect that to happen.
Okay, yeah, even if there were a slight dip in the banking sector's assets, then suddenly I guess an HDFC Bank re-rating can be on the cards because it has been historically the squeaky clean bank. Yeah, but let me come to the one where squeaky clean is exactly not there at all. Paytm. How do you approach this now? We have now some more clarity. My colleague Ritu Singh even broke the story on how KYC has been wanting, though the management cannot be faulted for any money laundering. It's KYC that's been wanting and the way in which PAN cards have been used, etc. How do you rate the stock now? Dip into the distress?
I think the broader comment that I would have out here is that it looks like the regulator is very focused on you know, managing systemic risks ever since they have gone down the path of broadening the number of banks, whether they be payment banks or small finance banks, and even in fixing governance structures within banks. I mean, at some point in time, you know, MD approvals were kind of a non-issue. I mean, there was no speculation around who's going to get renewed where and all of that. But now we have seen that, you know, I mean, RBI takes very differentiated calls, very nuanced calls based on, you know, how much rope they want to give to, you know, based on past behavior, or at least their approximation of what past behavior looks like. And from that point of view, I mean, I think all these regulatory actions form a string, which essentially gives you direction that, you know, the RBI is happy to use both the carrot and the stick. And, you know, I mean, you remember, HDFC Bank's, you know, new customer credit card issuance was stopped.
Absolutely.
The Premier of India, right? So there are no holy cows as far as the regulator is concerned. And I think in the long run, that will serve the Indian banking industry well.
Okay. So, well, I'm running out of time. So, overall, what are your buys in the NBFC space and banking as well?
So, in banking, I mean, the ordering remains the same. It's just, I think that HDFC Bank and ICICI Bank have a lot in them. And Axis Bank, Lata, you would appreciate that since we are now starting to talk about a mid-calendar year set of rate cuts, then, you know, Axis Bank with a relatively higher borrowings proportion, short-term borrowings proportion, will have the fastest repricing of liabilities. So it stands third, partly because we think that the liability side beta benefits in an easing environment is high. And next will come SBI. Everything else follows that. So that's
NBFCs. Yeah.
Going.
Okay. I don't have time for the mid caps, but give me one or two NBFCs.
So, for example, AU Small Finance Bank is a name we like. I know the market was fairly disappointed with the numbers they put out, and that disappointment has two parts. One is that market's disappointment with the relatively new credit card business, and markets question marks around the slippages that they have had in their more core part of the business, what used to be their, the business that as an NBFC they have thrived on. And all I would say is that we have seen the asset book put through a ringer in the period of COVID. We saw how fast it could bring it back. So I think election overhang kind of thing also, they can come back really from. Now, look, I mean, given how cheap some of the large cap stuff is, to make a very
compelling
pointed
case, yes.
for a mid cap name is hard. But amongst the mid cap names, that's the one we prefer. We really think this is going to be the year of large cap private banks. And most of that performance is probably be in the second year, by the time that the second half of the year, because by the time the market then see 1 year forward, the earnings look absolutely outstanding from the
Got it, Shantanu. I think I'll have to invite you yet again for an NBFC discussion, but this was most helpful. Thank you very much indeed for joining us with your thoughts on the banking sector performance. It's been mixed, but every analyst is betting that the big banks are going to come back, and this will be the year of the big stocks and the big banks. Wrap up on Bazaar, short past is up.